After spending some time away from investing, I woke up from my beauty sleep and thought I'd log into my investing account to check my investments. And what do you know? Has hit the fan. I was looking at my InvestEngine portfolio and I saw that much red that I actually thought I was on the Vanguard website. And it turns out that that wasn't a nice feeling. So to put my mind at ease, I had to do some research. And after a few days, I managed to find a secret study that explains how best to invest during these times, as well as some invaluable advice from Warren Buffett. So I'll show you how I use this information to make changes to my portfolio and make an investing strategy that will last a lifetime. Because we've just entered a bear market, meaning that the market has fallen over 20% from its peak value at the start of the year. This makes it the 15th bear market since 1947, with the other 14 bear markets ranging anywhere from 1 month up to 20 months and having drops of 20% up to 52%. So there's no wonder that these are such scary times. But we're not the first people who have been in a bear market. Millions of investors have been through plenty of them before. So I wanted to see what we could learn from other investors who have been in our shoes. So I started doing some research and came across rumors of a secret study. And you can find this study for yourself by typing Fidelity Dead Investors. Don't ask me how I found that. Fidelity supposedly reviewed the performance of its customers from 2003 to 2013 and found that the best returns were from its customers who were either dead or inactive. These are customers who either died and had their assets frozen or forgot about their assets. In this 2003 to 2013 range, one of the most savage bear markets ever tore investors a new one, the infamous global financial crisis. And this crisis caused investors to do a range of irrational things, whether it was sell out completely or try to sell out and then buy back in at the right time. The dead, however, don't get impacted by any behavioural biases. They let their portfolios get returns in peace. But the reason that this is a secret study is because, well, it turns out there's no hard evidence that this study actually ever happened. Does that invalidate everything that I've just said? Yes, maybe. I don't think so. And I'll show you why towards the end of this video. But now we're going to turn our attention to Warren Buffett, because where better to look for advice than from a guy who's been investing through all 15 bear markets since 1947, amassing a net worth of over $110 billion. In 1986, he famously stated in a Berkshire Hathaway chairman letter that we simply attempt to be fearful when others are greedy and to be greedy when others are fearful. And this could not be more relevant than in bear markets, because stocks are falling and every investor is losing money. So how can we compose ourselves and be greedy in the hardest of times? Well, Warren also said, if you're making a good investment in a security, it shouldn't bother you if it closed down the stock market for 5 years. What he means is that you don't need to check the stock market every day, whether you're investing in stocks or index funds. Simply not looking at the markets is going to make it easier to keep a level head, because you'll give yourself fewer warning signs to have to worry about. But before we analyse exactly what we can take away from this, we need to first address the elephant in the room. What if this time is different? There is a major war on European soil, an energy crisis that has the potential to get much worse, inflation is rampant across most major economies, the UK government has fallen apart, and even cryptocurrency is taking a huge hit. All of these crises are looking bleak, and it doesn't look likely that any of them are going to recover anytime soon. And whilst I don't want to play down some of the horrors that we're seeing in the world today, sometimes it's important to look at things from a fresh perspective. Let me remind you of the S&P 500 all-time graph that has been trending upwards ever since records began. From this perspective, it looks like a fairly steady climb, and whilst we see some declines, they don't look that awful. But now let's pick one of these declines. Say this one, and let's remind ourselves of the horrors of the 2008 global financial crisis. You know the story. Banks were lending out dodgy loans and mortgages, which fueled a massive housing bubble. And when that bubble popped, millions of Americans ended up owing more on their homes than what their homes are actually worth. Major banks ended up collapsing, and millions of people lost their jobs and homes. And it's not even like all of this turmoil just lasted a month or two. It lasted for over a year, which is a long time to have to try and keep making rational investing decisions. But what do we see now? A little blip in the road in the middle of a massive climb. If you started investing in 2003, investing £250 per month, you'd roughly be on £150,000 now if you sat back and did nothing. But most investors haven't achieved anything like this because of the mistakes that they've made, especially in 2008. This table from the 2020 Quantitative Analysis of Investor Behaviour report shows that the average equity fund investor trailed the S&P 500 by almost 5% over the past 30 years. They go on to say that this is because many investors withdraw their investments during periods of market crises. Since 1984, approximately 70% of this underperformance occurred during only 10 key periods. All of these massive withdrawals took place after a severe market decline. We are literally living through a period of market crisis, so the decisions that we make now will massively impact our investing returns. If I draw a hypothetical line that simulates how the market could look in 30 years, will we even notice this blip in the road? If we can remove our emotions from the current situation, we may be able to see things from a long-term perspective. But of course, all of this ignorance is fine if you have no reasons to withdraw the funds. What if you were to lose your job, or you had some short-term goals that you wanted to fund? Well, this comes back to having a suitable investing investing plan, making sure that you have an emergency fund to cover you on rainy days, and making sure that you maintain a long-term investing mindset. The longer that you're able to keep your money invested, the more likely you are to end up with a positive result. Whilst the shorter your investing horizon, the more uncertainty you have, and the more likely that you are to withdraw during a market decline. But regardless of what happens in the future, how can we take on board the advice from the Fidelity study and from Warren Buffett to make real changes to our investing strategy today? Well, by using Buffett's advice of being greedy when others are fearful, I recently made two of the largest investments that I have ever made. As the bear market started to develop, I realized that this was a perfect time to be greedy and made a £1,000 investment towards the end of May. I even sacrificed some of my short-term savings to make sure that I could get as much invested as possible. But the market kept falling even further the next month, so keeping Buffett's advice in mind, I invested £600 towards the end of June, taking my account value up to around £2,400. But regardless of me chucking all this money in, I want to make it clear that I am not trying to time the market. I always try to make monthly investments, but I tried my best to deposit as much as possible in these 2 months whilst the market was down. And then learning from the Fidelity study and the investor behavior report, I figured that it would be best to turn my attention away from market news. I turned off notifications from my investing news apps and stopped paying attention to all the doom and gloom stories in the news. I figured that that would make it easier for me to stay invested, even if the world around us is falling apart. So I was happy to get back into bed, go to sleep, and wait till this all blows over. But if you really want the best investing returns, then surviving bear markets is not going to be enough on its own. If you want the maximum chances of success, then you need to make sure that you're invested in a portfolio that is 100% suited to you. And that's why you need to watch this video here, where I show you how to find the best ETFs for you based on your own preferences.